Meanwhile, Fed Chair Powell's testimony before the Senate Banking Committee just wrapped up. He told Congress holding rates high for too long could jeopardize economic growth. Let's dig into what it all means for the next rate decision. Greg Daco's here. He's EY-Parthenon's chief economist, alongside our very own Steve Leisman. Gentlemen, good to see you. Steve, a pretty clear opening the door to a September cut here. Is July still in the, unlikely camp?
Yeah, I'd say in the unlikely camp and making some, let's say, rhetorical progress towards the possibility of a September cut. I don't think he committed, but he did sort of go with maybe a couple steps further than he went last week in Portugal, talking about the, significantly less tight labor market, saying the likelihood of the next move is a loosening, though not committing to a timing, and talking about considerable cooling to the labor market and emphasizing the dual risks that they have, and sort of joining along with some of the more dovish members of the Fed who have spoken, Kelly, who said, you know what, there's an emerging need to spend more time thinking about the second part of the mandate, that is the employment part of the mandate. So he sees, he added a few adjectives from his prepared remarks during the Q&A, but not much in terms of when you look at how Fed funds moved. Really, they took it a little bit more hawkish than perhaps they were expecting. Yeah, yields are a touch higher, and the probability is just a touch lower. Still looking at a 73% probability of a second cut in December, and upwards of 70 or 80% for one in September or November.
So in other words, Greg, markets wanted more. They wanted him to kind of give us a little bit more hint that cut might be coming, and that focus on the, everyone's talking about Claudia Samm's post today where she seemed to say, yeah, it could be time for cuts now.
Yeah, I mean, it's time for the Fed to start considering calibration of policy, recalibrating monetary policy to today's conditions. We have an economy that is gradually slowing, not retrenching, but consumers are being more prudent with their outlays. We're seeing the labor market also cool. There was some very interesting research from the San Francisco Fed saying the break-even pace for payrolls with higher immigration is around 230K. We're currently running at a 3-month moving average of about 180K. So we're below that, and that's why the unemployment rate is gradually rising. So we are at a state at which the Fed should gradually consider recalibrating monetary policy. I was saying about a month ago that July would have been an optimal time to do so. Yeah. I think September will be a little bit late even potentially to do that.
And I mean, Greg, it's funny because it feels like you're right, but at the same time, people might say, well, what's the big deal? 6 weeks here, 6 weeks there, a quarter point, cut here, a quarter point there. What's at stake?
Well, I think the risk here is that we have a more material slowdown in the labor market that happens in the coming weeks, in the coming months. We know that the labor market payrolls report is one that is a lagging indicator. So any weakness that we see in prior months may be just the initial sign of a slowdown that may be more profound. So right now, what the Fed should do and should look to do is really recalibrate monetary policy in a gentle manner to accommodate today's economic circumstances, not do so too rapidly once it starts to see a much more pronounced slowdown in economic activity. So being ahead of the curve and having that forward-looking perspective is really something that has been missing and should really be a key consideration for Fed policymakers today.
Go ahead, Steve.
Yeah. Greg, I worry about the Fed's reputation if it misses this turn. I think the Fed has had a lot of warning and had a lot of reasons to reduce rates, at least marginally, in the sense that they reached a peak rate about a year ago. It'll be this meeting coming up where they reach the peak rate. They're seeing now it's a year on that those rates are starting to bite. You've had a tightening of financial conditions in the sense that real rates have risen relative to the inflation rate. I think there is the economy at stake here and jobs. That's the most important thing. But I feel like it's going to be very difficult for Powell to explain away, if there's a recession here, how he missed this.
I think you're absolutely right. I mean, missing it on the two sides, right? Initially, when inflation was more persistent than initially anticipated,
that's the reason,
fast enough. But even on the downside, now here we have the possibility of a downside risk to the economy. I was very much encouraged by the statement in Powell's testimony today saying that inflation is no longer the only risk we face. That two-sided risk approach and view is increasingly important in an economy that is gradually turning. Again, we're not talking about a recession. We're not talking about a retrenchment in private sector activity. We're talking about recalibrating monetary policy to be on a sustainable trajectory and ensure that the economy has more legs to run and manages to run at a higher clip than would be the case should the Fed maintain an excessively restrictive environment in an environment where the labor market, as Powell said, is balanced.